Happy Saturday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Now, before we jump in, a quick piece of housekeeping. You've probably noticed that this is a different environment. I have returned to my home country of New Zealand to see my family, and I'll be here for the next several weeks. So this will be where I'm filming. Please forgive the informality. This is a family friend's home. They've been very kind to let me record here while I'm here. Now, while I'm in New Zealand, I plan on visiting Auckland and maybe even Wellington, and I would like to do subscriber meetups for those who watch China Update and Market Update that are in or near Auckland and perhaps Wellington. So if you're in one of these cities and you'd like to attend, I would love to see you. It's a very casual meetup. Please send me an email. The email address is in the description below. Let me know that you can make it either to Auckland or Wellington, and once the details are sorted, I will send those through. Now, with that said, there is a lot to cover today, so let's jump in. And first up, we begin in North America. A wave of record-breaking capital investment is transforming data center construction into one of the largest infrastructure booms in modern history in North America, as technology giants and financiers race to meet surging demand for artificial intelligence computing power. Meta, OpenAI, and Elon Musk's xAI are spearheading projects such as Prometheus, Stargate, and Colossus, each costing more than $100 billion. Yet these supercomputers are only a fraction of the required spending. The true cost lies in data centers, sprawling, power-hungry complexes now at the heart of the $3 trillion build-out over the next 5 years. Hyperscalers, Amazon Web Services, Microsoft, Google Cloud, and Meta are projected to spend over $400 billion on data centers in 2026 alone, following $350 billion this year. But generative AI's immense computing needs mean internal funding is no longer enough, even for these massive technology giants. While big tech covered up to $200 billion of costs last year from cash flow, Morgan Stanley estimates they will require $1.5 trillion in external funding by 2029. Private equity, sovereign wealth funds, and banks are rushing to fill the gap. Debt is becoming the dominant funding tool, with about $60 billion in loans backing $440 billion of projects in 2025, double last year's level. Meta recently raised $29 billion, mostly debt, from investors led by Grimco to fund facilities in Ohio and Louisiana. Oracle, meanwhile, is leasing a 2-gigawatt data center in Texas, Blue Owl Capital, part of a $30 billion a year deal to supply computing power to OpenAI. Developers tout so-called build-to-suit models, securing long-term leases with investment-grade tenants before breaking ground to attract lenders wary of construction risk. Blackstone, which bought Australian operator AirTrunk for $14.9 billion, says demand for both infrastructure and AI-specific hardware, such as NVIDIA GPUs, creates financing opportunities far beyond real estate. But the rapid build-up has sparked warnings of overcapacity, echoing the late 1990s telecoms bubble. If AI adoption falls short, hyperscalers could be left with billions in stranded assets. Data centers optimized for AI training may see diminished value as workloads shift toward inference, and the fast pace of chip innovation risks making today's costly cooling systems obsolete. The market's exuberance is drawing in increasingly speculative projects, some without anchor tenants or backed by non-investment grade AI startups. Loans secured against GPUs are proliferating, but the hardware's value is vulnerable to rapid obsolescence as NVIDIA launches faster models. Some investors are turning to securitization to extract cash from completed assets, while others avoid such debt entirely, fearing the facilities may be outdated before loans mature. Quote, "There's a risk in 10 years you will have a shed of obsolete GPUs and cooling infrastructure," end quote. One industry figure speaking to UK-based The Financial Times warned. While hyperscalers can absorb potential losses thanks to scale, smaller developers who have borrowed heavily are more exposed. As one executive put it, quote, "Microsoft and Amazon don't know what they need. They're just gobbling up everything because popular opinion is that it's a winner-takes-all market. The people who will suffer from the pullback are the over-leveraged data center companies." End quote. Next up, we move to Asia. Unlike China's economy, which we discussed in yesterday's episode of China Update, my other channel, which received some very bad news on Friday, Japan received rather positive news on Friday. Japan's economy grew faster than expected in the second quarter, supported by solid domestic demand and corporate investment, providing the Bank of Japan, Japan's central bank, with a stronger case for another interest rate hike this year. The upbeat figures also offer embattled Prime Minister Shigeru Ishiba a rare dose of political relief. Gross domestic product expanded at an annualized pace of 1% in the April through June period, more than double economists' medium forecast of 0.4%, according to Cabinet Office data released yesterday, Friday. The previous quarter's performance was also revised up to 0.6% growth from an earlier reported contraction. Business investment surged 1.3% from the prior quarter, exceeding the consensus estimate of 0.7%, while private consumption, accounting for nearly 60% of GDP, rose 0.2%, slightly above expectations. Net exports added 0.3 percentage points to growth as exports climbed 2% in real terms despite heavy US tariffs, aided by front-loaded shipments and robust inbound tourism, which saw foreign visitor spending jump 18%. We note that tourism is a service export and so comes under the export numbers. The stronger than expected showing is likely to fuel speculation of an earlier Bank of Japan rate hike. While the central bank is expected to hold rates steady at its September 19th meeting, 42% of economists surveyed by UK-based Reuters now anticipate a move in October. Governor Katsuo Ueda has signaled that further hikes are possible if domestic demand remains firm. Quote, "The chances of an October hike have gone up," end quote, said Atsushi Takeda, chief economist at Itochu Research Institute, adding, quote, "The market consensus also seems to be shifting toward an earlier move." End quote. Markets reacted swiftly to the data, with the yen strengthening as much as 0.3% against the US dollar and the Topix Bank Index rising 4% on bets that higher interest rates will bolster financial sector profitability. The quarter's performance came despite significant trade headwinds. In April, the US imposed a 10% baseline tariff and 25% levies on Japanese cars, alongside higher steel duties in June. Ishiba's government has since negotiated an agreement to lower car tariffs to 15%. And last month, a trade deal with Washington was concluded. Although the government cut its full-year growth forecast to 0.7% from 1.2% earlier this month, citing global uncertainties from US trade policy, the resilience of business investment and consumer spending suggests the economy may weather external shocks better than feared. Wage gains exceeding 5% at major companies are expected to further support household consumption in the months ahead. Economists caution, however, that the third quarter could reflect a sharper drag from tariffs now that export front-loading has ceased. Persistent inflation remains another challenge, with July price data due next week likely to show consumer inflation running above the Bank of Japan's 2% target. Quote, "The target is whether exports can hold up," end quote, the previous mentioned Takeda said. Quote, "If they do, the Bank of Japan may feel comfortable tightening policy sooner rather than later." End quote. If you want to be on top of the most up-to-date analysis on the biggest developments from the world's most important markets, consider subscribing to Market Update. Hit the bell notification icon and you will be. And if you're getting some value from today's episode, don't forget to hit the like button. Now, we usually do Europe after North America and Asia. Because I have returned to New Zealand for today, instead of a European country, I'll be ending with a New Zealand update. Unfortunately, my home country of New Zealand has seen several concerning signs this week that its economy is in poor shape. New Zealand's concrete production, a useful proxy for economic growth, has fallen to its lowest level in more than a decade, underscoring persistent weakness in construction activity as the economy struggles to gain traction after last year's deep recession. Statistics New Zealand reported this week that output in the 12 months through June totaled 3.7 million cubic metres of concrete, down 5.9% from the previous year and the smallest annual volume since late 2014. Quarterly production in the April through June period dropped 10% from a year earlier to 891,000 cubic metres, continuing a slide from the late 2022 peak of nearly 4.8 million cubic metres. The slump reflects both a slowdown in residential building and weaker demand for new commercial developments, while home building consents rose 1% in the year through June, hinting that housing demand may have stabilised. Non-residential floor area approved for construction fell 5.2%. Economists attribute the softness to subdued economic growth, elevated uncertainty, and cautious business sentiment. Despite the Reserve Bank of New Zealand's recent easing cycle, with another cut to the official cash rate from 3.25% to 3% widely expected next week, cheaper borrowing has yet to meaningfully stimulate construction. Investors currently see around a 60% chance of the OCR, official cash rate, falling further to 2.75% by year end, though many analysts believe 3% could mark the cycle's low if activity picks up in the second half. The broader economic outlook remains fragile. Growth in 2025 is projected at 2.4%, supported by strong export returns and lower interest rates, but headwinds persist. Trade tensions, cost of living pressures, and a slow pass-through of monetary easing into household spending are all weighing on momentum. Fiscal policy is unlikely to provide a major boost before the 2026 budget, as the government targets a return to surplus, that is fiscal surplus, by 2028 through 2029. Despite the poor economic numbers, one of the bright sides for the New Zealand economy is that it has very low government debt, something that is quite the rarity in many countries around the world today, with a tradition of New Zealand governments prioritising being in a fiscal surplus. One of the reasons for this is because as a small export-reliant economy, New Zealand is incredibly vulnerable, and so the government has always wanted relatively clean and healthy balance sheets. Compounding the economic challenges, however, New Zealand is experiencing its largest net outflow of citizens in 13 years. In the 12 months through June, 71,851 citizens departed, the most since 2012, while only 25,353 returned, resulting in a net loss of 46,497. The exodus, driven largely by younger New Zealanders seeking better paying opportunities abroad, particularly in Australia, has contributed to the sharp slowdown in net migration. Net annual immigration fell to 13,702, the lowest since November 2022, and down steeply from the October 2023 peak of 135,529. While departures have risen, the major driver of the decline has been a slump in arrivals, as foreign workers shy away from the cooling job market. While this is not that positive for the economy, it may take some political pressure off the government, as in New Zealand, like many Western countries in recent years, there has been a growing concern about excessively high immigration numbers. With unemployment rising and business investment sluggish, some economists warn that GDP may have stalled in the June quarter. The Reserve Bank of New Zealand's projection for just 0.7% annual average growth this year underscores the scale of the recovery challenge. For now, policymakers are betting that lower borrowing costs, stable export demand, and a gradual lift in construction activity will revive growth. But as one economist put it, quote, "The question is no longer whether the economy will turn. It's how long we'll be asking, are we there yet?" End quote. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Saturday, have a restful weekend, and I will see you for a new week of developments on Monday.